Welcome to This Explainer. Okay, today we're gonna bust a massive, deeply ingrained myth in the finance world. You know the one, the idea that grinding harder, staring at screens for hours on end, and just putting in relentless effort automatically equals more wealth. We're putting day trading head-to-head with index funds to answer one incredibly simple question. Which one is actually gonna make you more money?
Okay, let's dive into this with a really fantastic quote. Activity is loud. Progress is silent. See, our brains are basically hardwired to confuse being busy with getting ahead. When we see a flurry of action, we just instantly think, oh, results must be happening. But the stock market, it doesn't pay you for your effort. It pays you for your edge. So keep this distinction in mind, because we're about to look at two totally distinct paths that prove this perfectly.
Let's meet Ryan and Sam. And to make this a completely fair race, we're giving them the exact same starting line. Both guys are 28 years old, both make a $55,000 salary at their day jobs, and they both managed to save up exactly $30,000. Literally, the only difference here is what they do with that money and their time. Ryan decides he's done with the 9-to-5 grind, right? So he buys a $1,500 day trading course, sets up 2 giant glowing monitors, and jumps into Discord servers filled with guys posting rocket emojis. He's trading before work, during lunch, late into the night. Sam reads that almost nobody beats the market. So he shrugs, dumps his 30 grand into a broad index fund, sets up an automatic $200 monthly deposit, and basically just goes to sleep.
So, who actually wins? Let's start the clock on our 20-year timeline at year 0 and track exactly what happens to both of these guys. By year 1, we run right into what's famously known as the year 1 trap. Because early on, Ryan's story looks absolutely incredible. He hits a massive hot streak on some tech names, and by spring, his $30,000 account has jumped to 38, maybe even 40 grand. He is crushing Sam, who's sitting quietly at around 35,000. Ryan's screenshotting his green days, posting him in the group chat, and frankly, feeling like an absolute genius. If we stop the explainer right here, you'd swear Ryan made the smarter choice. But, a coin that lands heads 5 times in a row feels exactly like skill, too. This early win, it's arguably the most dangerous lesson the market could possibly teach Ryan. It perfectly mirrors the illusions sold by all those online course creators posing next to rented Lamborghinis. The early win feels incredibly real, but fundamentally, it's just a coin toss disguised as mastery. Fast forward to year 3 and the coin starts landing tails. Hot streaks always revert, and Ryan hits a brutal stretch. He falls into something called revenge trading, basically breaking his own rules to try and quickly win back a loss. There's this Tuesday in March where he doubles down on a losing position, watches it fall straight through the floor, and loses a massive chunk of change. Just like that, his account gets wiped right back down to roughly his starting 30 grand. Meanwhile, Sam hasn't even looked at his account in ages, yet his balances quietly climb to about $47,000 or $48,000. Now, what's really interesting about this slide is, you might think Ryan is just having bad luck. He isn't. The harsh reality of the data shows he is mathematically completely normal. In a massive study out of Brazil tracking day traders, researchers found that of the people who stuck with it past 300 days, the really committed ones, right? A staggering 97% of them flat out lost money. Not underperformed, they actually lost money. Oh, and it gets even more brutal. An exhaustive study by economists looked at an entire stock exchange in Taiwan over 14 years. They found that fewer than 1% of day traders could reliably earn a profit after factoring in all those hidden costs and spreads. Less than 1%. And here in the US, the data tells the exact same story. The most active traders, the ones making the most moves and trying the absolute hardest, actually underperform the market baseline by 6.5 percentage points every single year. The market basically charges a steep rent on activity. The spread on every single trade, paid hundreds of times over, simply bleeds the account dry over time. By the time we hit year 5, the shape of Sam's trajectory is totally changing. It's not crawling anymore, it's curving upwards. Compounding is really taking over here, pushing him to $63,000. His money is now earning more per year than he even puts in. For Ryan, statistically speaking, 85% of day traders have quit, blown up their accounts, or gone back to regular life by year 5. Let's shift our perspective for a second to the massive, hidden temporal cost here. To break even or lose money, Ryan has spent between 7,000 and 10,000 hours of his one and only life just staring at glowing screens. Sam? He spent 1 hour total setting up his auto deposit.
Measured by the hour, Sam is quietly the highest paid person in this entire explainer, and he was literally asleep for most of it. As we cross the decade mark at year 10, these two lives aren't even comparable anymore. Sam's account crosses $116,000. He's experiencing silent compounding while actually living his life, taking vacations, getting promotions at work. In the background, his money is effortlessly out-earning a man who is working a full-time second job just trying to beat the market.
Now, I can already hear the objection. But skill exists. The best traders win. Okay, sure. Let's look at the SPIVA scorecard. This tracks the actual professionals. We're talking people with economics PhDs, massive research teams, and expensive Bloomberg terminals. Over a 20-year period, 92% of these elite professionals still lose to a simple index fund. 92%? No way, right?
Even Warren Buffett proved this with his famous $1 million bet. It's such a fascinating story. He wagered that a plain old index fund would beat a hand-picked basket of brilliant elite hedge funds over a decade. He won so decisively that the other side actually conceded early. The index returned about 7% a year, while the incredibly expensive hedge funds returned about 2%. So when Ryan tells himself he's going to be the exception, he isn't just competing with other beginners. He is losing to the exact same fund that the elite pros lose to.
Now, to be completely impartial, index investing isn't some risk-free magic trick. It actually has its own brand of hard work. During the 2008 crash, the fund Sam's money is parked in dropped 37%. Over a third of his wealth just vanished on paper. In 2020, it plummeted again. Sam's hard work was sitting on his couch, looking at his shrinking account with his thumb hovering over the sell button and forcing himself not to press it. That emotional regulation? Doing absolutely nothing when every instinct screams at you to panic? That is the real heroic act of investing.
And this brilliantly illustrates another massive headwind for Ryan: taxes. It's almost like a hidden penalty for activity. When Ryan makes a quick winning trade, the government calls it a short-term gain, which is taxed like an ordinary paycheck at 22, 24, or even higher percentages. That gets skimmed off every winning trade, every single year. Sam's growth, on the other hand, is a long-term gain, often taxed at a much lower 15%, and he doesn't pay a single cent until he sells decades later. The tax code is literally designed to shrink Ryan's pile every April, while Sam's money compounds completely untouched.
All right, let's jump straight to the 20-year finish line and reveal the final, staggering gap between these two completely distinct paths.
The final numbers really speak for themselves here. Sam's account is now sitting somewhere between $250,000 and $340,000. He only put in about $78,000 of his own money. The entire rest of it is pure compounding because he just left it alone. Ryan? Well, the overwhelming odds say he stopped trading years ago. Best case scenario, he has his original $30,000, plus 10,000 completely lost hours of his life. The bitter truth is that the only guy reliably getting rich from Ryan's strategy was the man who sold him that $1,500 trading course on day one.
We definitely have to be balanced here, though. Day trading isn't inherently evil, and it actually makes sense in a few very narrow situations. Like if it's treated as a rigorous, real business with a tested edge where you're risking tiny slivers of capital, if it's a legitimate career at a prop firm or quant desk with a steady paycheck, or if it's purely entertainment money you can comfortably afford to set on fire, kind of like a golf budget. But for everyone else, it is simply a job with a 99% washout rate that aggressively markets itself as a shortcut.
So the crucial point is this: the real trap was never actually about day trading versus index funds. The trap was believing that the effort you put in should automatically match the money you get out. In investing, that relationship is totally backwards. The market rewards patience, and patience looks an awful lot like laziness right up until the exact moment it looks like absolute genius. The next time someone shows off their trading screenshots, don't ask how much they made. Ask them, how many hours did that cost you? Because the guy who bought the boring fund wasn't being lazy. He was being paid in the one currency day traders always forget to track: the time you never get back. Thanks for joining me on this explainer. I really hope this changes how you view your time and your investments. I'll catch you in the next one.